Hi there, back with some pro tips for your investments, and I mean pro tips very literally. I've been an asset manager and financial planner, as well as an active stock trader for a long time, a couple decades now. Time flies. So today, I want to use an example to show you two things. First, more problems with traditional financial planning, the way it's always been done, and the way most advisors, yes, even fiduciaries, especially fiduciaries actually, continue to do this. Second, why traditional advisors miss the mark when they try to explain a strategy of diversification, but they make some terrible mistakes in how they present this. So one of my mentors, Jason Stapleton, who I'm very grateful to, he's helped me out tremendously. He's had a very successful career himself in financial services. And he showed an interesting chart in a video recently, and I want to comment on the same chart and help you understand why you have to be judicious, even when the information is sort of right. Sort of. As in the case of this chart, I'll show you. So a guy on LinkedIn, I'm not going to mention his name, no need to embarrass him. He ran this chart and he said the following things, and I'll give my response as we go along. So he said, if you're feeling scared or nervous about the markets right now, please read this. The first thing we need to do is focus on our long-term financial plan or create one now. This financial plan takes into account these types of black swan market events. Okay, so this is Kate speaking here. My response to that is yes and no, mostly no. When I was working as a financial advisor, I would see a ton of plans that were done by other advisors that new clients would bring in. And they would promise sunshine and roses and rainbows for all eternity. I've also seen plans that extrapolate out 40 years, which is insane. And this is the part where financial planning can get it very wrong. First, to tell you that you'll be okay. In fact, a multi-gazillionaire, which is what they do, in 10, 20, 40 years is probably crazy. So much can happen globally and in your own personal situation over that time. So I would argue you and your planner should really be focusing on the shorter term and doing regular check-ins to be sure your behaviors are on track and your situation hasn't changed. I don't just mean the quarterly review to go over your investments. That's kind of silly. Again, that's the way the industry has worked in the past. Doesn't work that way anymore today. Second, these financial plans do cover annualized returns. So they do anticipate down years in the market, not necessarily a black swan. But this can't really be modeled and presented in a nice linear fashion the way these plans are laid out. So here's an example to show you. You see that? Straight across market gains. Now that is not what the planner, if they're a good planner, actually expects to happen. It's annualized, meaning that the software picks an average return, including compounding, but you can't forecast in a plan exactly what will occur and when, and more importantly, how an investor might emotionally react when the market falls 20, 30, 40, 50%, because the anxiety that comes with that, you can't quantify on a plan what you'll actually do in that situation and how it will affect your finances and your life in real time and how the compounding and the market gains will actually occur. So it's inexact. I mean, there's a degree that it's fiction. Now, good planners know it's inexact, the good ones do, and they communicate that to clients. But it's pretty dense stuff, and most of the time, for most people, you're not a financial expert. This stuff doesn't particularly interest most people, and people's eyes just kind of glaze over. Okay, so let's move on to some other problems with this LinkedIn post. So this guy says, remember that a diversified portfolio is not all in stocks. If you have a diversified portfolio of stocks, bonds, real estate, etc., then what the media is saying about the stock market does not map directly to your portfolio. Okay. That's sort of correct, but when you're watching the markets decline in the double digits, you're probably not thinking, oh, hey, that's no problem because I'm so well diversified. No, you're watching the stock market decline because that's what the media is talking about, and that's what you're watching. So on the one hand, I absolutely agree with the premise of diversification for long-term retirement needs. Long-term is the key phrase there. It's almost never going to work out well if you have one asset class, big U.S. stocks, which is what most Americans traditionally have held, and many still do. Broad diversification will be the best possibility of smoothing out your return over rolling periods of time. So yes, I am a proponent of the efficient market hypothesis. Yes, asset class diversification should be incorporated in your long-term investment strategy. But I have a little problem with the way this was presented here, and I want you to watch out for how some planners present the evidence. So here's the chart this guy used to illustrate market rebounds, referring to health crises and viruses. So a couple things I take issue with here. First, not all these viruses had the effect on global economies that COVID-19 already has. So there's some false equivalency here. And to be fair, he put this up about a month ago. Okay, give him that. But nonetheless, you can't make these comparisons accurately. I see what he's trying to do. He's trying to paint a picture of market rebounds, and markets do traverse higher over time. That's true. But to say that this time is just the same as others, no, not while we're in the thick of it. This is really bad right now. So don't insult us. We all know this is not the same as others. Second, let's take a look at this chart he's using here. The MSCI ACWI index. What the heck? Okay, so I was being a little dramatic there. As someone who's been a money manager and a financial planner, I do know what that is. But it's kind of ridiculous to show that because who else besides me watching this knows what that is? Goose egg, right? It's the All-Country World Index, and it tracks companies from around the world, including the US. So I kind of see what he was trying to do here, to show the effects of a little more diversification in your stock portfolio than you might find in just a US fund, like the S&P 500 or the Dow. But this does not really make the point about broad diversification, which would include stocks, bonds, investable real estate in the form of real estate investment trusts. Here's something that might reflect better what more broad diversification would look like, including global stocks as well as bonds. This is the DFA Global Allocation 60/40 portfolio, holds 60% global stocks, small and large from all industries. So even the equity side is more diversified than just the ACWI that was in the original LinkedIn post. But it's further diversified with a 40% holding in short-term, high-quality bonds from developed markets and from different industries. So that too adds potential to smooth returns that you won't find in just one index like the ACWI. Now here are the two, the ACWI and the DFA 60/40, in a comparison with the two compared versus a neutral index level of 100. So you can easily see how a diversified portfolio actually does perform better during most time periods. So if you're trying to make the case of how a retirement portfolio might behave, I would not use the ACWI. A couple reasons I don't like using that one. It's a very obscure index, not one that people know about, not one that Americans are likely to be holding most of their retirement assets in. I wouldn't use that as a proxy for market action. It's just not representative of how an actual retirement portfolio might behave. Okay, one last thing today. This comes back to, frankly, I'm sorry, some of the worthless advice you get from the traditional financial services industry. The original post read, "Times like right now are when the real money is made in investing. It's easy to be an investor when the markets are going up, but if we let our emotions rule us during downturns, we will see dramatically lower returns over the long term. Maintain a long-term, unemotional perspective." Yes, it is true that emotion-driven panic trades do tend to result in a worse outcome. And what I mean by that is lower account value, maybe you outliving your money in retirement. But this is much more about behavior than math. Because does the math work out better if you sell out before a market downturn sit it out perfectly, then get back in at the right time? Well, yes, without a doubt, the math works best. But are most people really going to do this, and should you be? No, especially, I'm talking about retirement accounts today, but just for a second, I'll talk about if you have a taxable account with a lot of capital gains. At some point, yeah, we will. Feels awful right now. We will be in good markets again at some future date, and the capital gains are much more of a concern during those periods of time. So something to file away. But really, when you are focusing just on your retirement accounts, unless you're a student of trading, which I have been for years, I taught trading at Investors Business Daily. I even did a trading radio show on Tiger Financial News Network. Or unless you're trading in a specially designated trading account, your chances of making market timing work in a retirement account, like an IRA or 401k, are very low. And I'm going to tell you how low they are. I've never seen it done successfully on a consistent basis. I've worked with a lot of clients now for years. And I'm talking about retirement accounts specifically. And that is where I do recommend broad asset allocation. And the emotional component of these market downturns can be larger than people estimate. So unless your portfolio is allocated in a way that you can sleep at night, it sounds cheesy, but it's true. If you're anxious about it and worried, then something is wrong. You're taking too much risk. I want to end today with a quote from a recent New York Times article interviewing David Booth, who founded Dimensional Fund Advisors back in the 1980s. Dimensional is a company I've worked closely with over the years. I have the utmost respect for them. And here's what Mr. Booth says. The textbook answer is to find an asset allocation you can live with for a long time. This isn't science. It's about human behavior. And if you're freaking out, the first thing is you've got to find a way to get comfortable. Now, I've talked about some of these ways to get comfortable with your investments in some previous videos. I'll come back and talk more about that. I'll refer to an article I recently wrote for U.S. News and World Report on that very topic. But I'm going to leave it at that for today. I've covered a lot. Thanks again to Jason Stapleton for alerting me to this post. As you can see, gave me quite a bit of fodder, and I found some reasons why it points out problems with the traditional financial planning industry, outdated, outmoded, really does not help in many, many ways. Not saying you shouldn't have a plan. Be careful about how you do the planning and who's doing the planning, okay? You don't have to put up with substandard planning. Thanks again for watching. I'll see you next time.